Dan Passarelli of Market Taker Mentoring joins me now for Stocking Up. Good to have you back on the show. It's been a while, Dan.
Great to be back, Angela.
So one of the stocks that Dan is watching for us today is Goldman Sachs. Now, this is a big bank. Getting some bashing lately on the political scene, but people actually do want to own this stock.
Yeah, and owning the stock is one thing, but for shorter term traders, you can take a bullish position that's arguably better, lower risk, greater reward by using an option spread instead.
So let's take a look at your strategy here. Where's the stock trading around? What's the range?
Well, it's sort of in that sort of 150-ish range. Now, I'm looking for it to go a little higher, but probably not too much higher. So my time horizon is maybe the next couple of weeks. So the trade that I like is buying the regular April 150, 155 bull call spread. Okay?
Okay.
Yeah, so that trade has limited risk. The most you can lose is whatever you pay for the trade. And if Goldman rises and ends up at or above 155, so not a real far off target, you can get a really highly leveraged profit potential.
So let's take a look at how much you would actually pay for that trade. What would be your limit, or what would you look at here as far as buying those call option contracts?
Yeah, if I could buy the spread for $3 or less, I'm pretty happy. If we get too far above that price, then the risk reward isn't quite as good. And so, you kind of have to watch, you kind of have to watch the stock. If between now and when people watch this video, Goldman rallies a whole bunch, then the trade's not quite as strong.
But if it does go up and things go your way, let's talk about how you make money from there. Do you sell those calls to somebody else?
Right. So I have a rule that we teach all of our students at markettaker.com, and that is whenever you can take 75% of your maximum profit on a trade like this, take it. Okay? So if for example, I paid $3 a share for this trade, the most I could make is $2, which is great. That's a 66% profit. Okay? But instead of being kind of greedy and hoping to get that whole $2, if I can close it for, say, a $1.50 profit, just 75% of that maximum profit, then, hey, that's good enough for me. I'd rather take my risk off and not risk having a profit and having the stock turn around and ending up with nothing.
If somebody says, I just don't want to do an options trade here, but I feel good about the stock because I like what I'm hearing from Dan Passarelli, may you be right. If somebody just entered the stock at the current level where it's trading, what do you anticipate would be the next move for the stock, say over the next 6 months or so, just from what you can read through the options flow?
Yeah, it's been tricky. I mean, the way the market's been changing around. I mean, I've said here on this show and other shows of yours that I think the market in general is going to be in kind of a long-term volatile range. And so I think that holds true for any individual stock that we talk about. The banking industry has its own issues and such, but there is a beta to all these stocks, and there is systemic risk and systemic movements involved with banking industry stocks, retail stocks, any stocks. So because I think the broad market's in a range, I think pretty profound dips in Goldman or any banking stock, I think is a good buy. But when we start to reach peaks, I think that's the time to start liquidating.
Dan, thanks for being on the show.
Thanks for having me.